How are defined benefit plan contributions determined? When it comes to planning for retirement, understanding how contributions to defined benefit plans are determined is essential. This process involves some key calculations that ensure employees receive the promised benefits when they retire. First, let's talk about the formula used to calculate the annual retirement benefit. The formula is straightforward. The annual benefit equals the accrual rate multiplied by the final average salary and the years of service. The accrual rate, also known as the multiplier, is a fixed percentage that indicates how much benefit an employee earns for each year of service. For instance, a common accrual rate might be 2%. This means that for every year worked, the employee earns 2% of their final average salary. Next, we have the final average salary. This figure is typically the average of the employee's highest consecutive 3 to 5 years of earnings, often occurring near the end of their career. This approach helps to ensure that the retirement benefits reflected the employee's peak earning years. The years of service is simply the total number of qualifying years the employee has worked under the plan. This factor is crucial because the longer an employee works, the higher their retirement benefit will be. Once these components are in place, actuaries step in. They calculate the expected retirement benefit and consider various factors such as life expectancy, interest rates, and other demographic details. This information helps determine the employer's required annual contribution. The goal is to ensure that there are enough assets in the plan to pay out the promised benefits when employees retire. From a retirement planning perspective, contributions to defined benefit plans can be substantial. Employers usually need to make these contributions regularly, whether annually or quarterly, to meet the funding requirements. The amount can vary widely based on factors like the employee's age, salary, years of service, and the desired retirement benefit. For small business owners, defined benefit plans can be particularly appealing. They allow for larger tax-deductible contributions, especially for those with higher income levels and longer service horizons. However, it's important to note that contributions must comply with Internal Revenue Service funding rules, and benefits must be uniform for all eligible employees. This can impact the total contribution amount, especially if there are employees of varying ages and salaries. In summary, contributions to defined benefit plans are not fixed amounts. They are calculated each year based on a specific formula that takes into account the accrual rate, final average salary, and years of service. This makes defined benefit plans quite different from defined contribution plans, like simplified employee pension individual retirement accounts or 401(k) plans, where contributions are typically a fixed percentage of salary and the investment risk falls on the employee. Understanding these details can help you make informed decisions about retirement planning.